Happy Friday. Brian Manning here with the weekly update. Let's get right to it. So Monday this week has had a lot of Fed talk. And, the Federal Reserve just seems, unfortunately, confused with what they're talking about because despite inflation coming down, it just feels like they still want to press forward with rate hikes. And you have Jerome Powell that just seems to flip-flop on this topic. So originally, we were looking at the headline CPI. So headline CPI, that's a consumer price index, has gone from 9% down to 3.2%. And that's where the Federal Reserve was originally focused because they said that's what the consumer feels. Okay, well, that's great because we saw progress there. Then they said, okay, well, now let's look at the core rate of inflation because the core rate strips out volatile items such as food and energy. I don't fully agree with that because all of us go to the gas station, we have energy costs, we have food costs, but they say, hey, let's strip it out. Okay, well, core rate of inflation's moved from 6.6% to 4.7%, and really it's the shelter costs that are holding us back. But again, they still want to proceed forward potentially with rate hikes. It's not confirmed yet, but it's just the tone and what they're talking about. So it just blows me away to see inflation coming down, but the Federal Reserve still wanting to press forward. I just can't understand. It's almost like they just want to see a really crummy jobs market. The jobs market is really not as good as they think it is or what they say it is. And we'll talk more about that in a second, but it's almost like they just want to start seeing really bad employment reports before they start making any progress as far as pausing rate hikes. We'll have to wait and see what happens, but that's the Fed talk this week. Tuesday this week, though, we got Case-Shiller. This is the gold standard for looking at home prices across the country. Let's do a quick screen share here. Let's look at what's happening in Case-Shiller. So Case-Shiller, looking at the month of June, was up 0.7%. This is almost at an all-time high. This looks at housing prices index for Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow. So this is all the most well-regarded companies that track home price indexes across the country, and you're seeing Case-Shiller up 0.7% in June. The reason why Case-Shiller is important is because Case-Shiller attracts all transactions. So FHA, VA, cash buyers, conventional mortgages, you name it, they track every type of transaction that goes through. FHFA for the month of June said home prices appreciated 0.3%. The difference is that FHFA across the country only looks at homes that have a conventional mortgage attached to them. So if someone got an FHA mortgage, a jumbo mortgage, a VA mortgage, or they paid cash, it's not tracking those numbers in there. So we're still seeing really good progress in housing, which is exciting. We're also seeing cities across the country that were leaders starting to make a comeback, Denver being one of them. So it's really great to see robust housing and just, strengthen the housing market. But you got to watch the media because the media is just, all over home affordability. And I totally understand that 34% of people are renting right now. But if rates drop 1%, 2%, and now we're back in a situation like we were a year ago, 2 years ago, where people have to pay $100,000, $200,000 cash above the list price, can a renter really afford that? Potentially not. That's, remains to be seen again, but I would say probably not. The thing about home affordability is like, yes, prices have gone up. Yes, interest rates have gone up, but incomes have gone up as well. If you look at how much incomes have gone up over the last couple of years, especially since COVID, incomes have progressed really nicely as well. So you got to be careful of the media because home affordability, depending on who you talk to, is going to be potentially a contentious subject. Also, we got the JOLTS report. The JOLTS report looks at job opening and labor turnover. I still don't understand what the Federal Reserve is looking at because this tracks job openings. If we look at what's going on here for job openings since COVID, you see job openings spiking after COVID, and then now they're starting to come down. It just still blows me away that the Federal Reserve is looking at this saying that we have such a robust job market, but I'm not sure where they're seeing it. When you've seen the job openings crest and you're now seeing them come down, I won't be surprised if you continue to see job openings decline, unfortunately. And then we have consumer price index that came out as well. Consumer confidence index is lowering because people are just generally concerned right now. So I think when you look at higher interest rates, the job market maybe not being as good as where the Federal Reserve thinks it is, consumer confidence index being lower, credit card balances being higher, I'm just not exactly sure where the Federal Reserve is seeing all the strength in the economy they're talking about and why they want to potentially stay on the path of higher rates. Wednesday this week, God, it was a big week, so much to talk about. Wednesday this week, we got the ADP report. So ADP looks at employment for the month of July. We got 177,000 jobs that were created. It was expected to have 200,000 jobs that were created. We're definitely see some cooling in the markets here as far as employment is concerned. Thursdays, we got PCE. So PCE is the personal consumption expenditure. This is the Federal Reserve's favorite gauge of inflation. PCE was up 0.2% on the headline number and the core number. what we have to be careful of watching here, and the way PCE works and all these inflation reports, is the number that we get this month replaces the same number from a year ago. Well, the number that we replaced a year ago was really low. So when you replace a really low number with a up 0.2%, it makes it look like inflation is increasing. We knew there was going to be a tough month this month because we knew that we were replacing a very low number previously, but we're going to see some better progress there going forward. Today, we get the BLS report. BLS is the Bureau of Labor Statistics. This gives us feedback on the government's report for job creations, again, also for the month of July. We had 187,000 jobs that were created. So this is, I think, the 4th or 5th month in a row, maybe 6 months in a row, where we've had sub 200,000. And then also we had unemployment. So unemployment ticked up and went from 3.5% to 3.8%. The other thing we wanted to look at is people that are filing for unemployment. And we're starting to continually see an increase of people that have filed unemployment, and they're staying on unemployment, and they're continuing to file for their unemployment claims, which again, unfortunately puts everything together to just really question, where does the Federal Reserve see such a strong labor market, and what's their path going to be going forward as far as rates are concerned. I'm around all weekend. If you want to know how we're closing purchase transactions in 15 days, give me a call. I apologize in advance for not having a text transcript. Ash is on vacation, hopefully enjoying herself in Europe right now, and they don't trust me with things like that. So this week we don't get any text transcripts. Hope you have a wonderful day. Happy Labor Day weekend. Talk with you soon.